Index funds cost more than you think, and I'm going to show you why. If you invest into index funds, or if you've ever looked at investing into them, there's a high chance that you've seen this. This is the annual fee that's advertised on each fund, and it's known as the OCF, or ongoing charge figure. The OCF is a percentage of your investment that you'll have to pay every year, and this is usually the only fee highlighted on the fund page for everyone to clearly see. But what if I told you that you'll be paying more than just this displayed figure? And there are actually 4 different fees you could end up paying when investing into an index fund. And we're not talking about the trading commissions or platform fees you incur when using specific brokers, so if you use a platform that charges these would be extras too. I'll break down the real fees you can incur when investing in index funds, I'll show you what the real percentages are, spoiler alert, they're higher than what's advertised, and I'll show you how much this could affect your investment over the long term. We'll simplify everything by looking at real examples of funds via Vanguard, but please note that these aren't investment recommendations. The first fee you'll always have to pay regardless of what fund you invest into is the fund fee, sometimes referred to as the ongoing charge or total expense ratio. And as I mentioned before, this is the only fee that you'll see displayed on the fund page, though you will also see this. We'll get to that a little later on. The OCF, described as the ongoing fees when analysing the real costs of Vanguard funds, is the only fee you know in advance. So the 0.22% or whatever it's listed as is the minimum that you will pay. The other fees can and will change on an annual basis, and annoyingly, it's pretty hard to find out what you're actually paying. You can get a rough idea based on what everyone in the fund paid, but you'll only get estimates based on averages. Ongoing fees are usually under 1% of your investment, but not always. As you can see here, we have 2 example funds. The FTSE All World ETF, which has an ongoing charge of 0.22% a year, and then the Global All Cap Index Fund, which is just ever so slightly higher at 0.23% a year. This means that you'd be paying more in fees when investing into the index fund rather than the ETF, right? Well, maybe not actually. We'll see. On top of the ongoing charge, there are 3 other potential hidden fees that you could be paying without even realising it, meaning there's a chance that you're losing a lot more to fees each year than you thought. Every time you buy or sell an exchange traded fund, or ETF, you'll pay a one-off charge, often called the bid-offer spread, and this is the small difference in price between the highest amount someone is willing to buy it for and the lowest price someone is willing to accept to sell it. This fee exists to ensure that market makers can earn a small profit when buying and selling in quick succession, and to help protect them from potential losses during volatile market conditions when asset prices can move suddenly. For highly liquid funds that are traded frequently, this fee will be very small. But if you're investing in a more niche fund with low trading activity, you could be paying much more every time you buy or sell. However, in terms of our 2 fund examples, this fee would only apply to the ETF. Vanguard's mutual funds do not incur one-off fees in the UK, though other mutual funds can incur them. Although you can never know exactly how much this one-off fee will be, Vanguard do provide an estimated figure based on the rolling average for each fund over a 30-day period, and in this case it's listed at 0.1%. But seeing as you won't pay this fee when investing into more traditional index funds, does that mean that the global all cap could theoretically end up being cheaper? Well, not necessarily, as not only could this fee differ every time you buy or sell, there are also other fees to pay that are typically higher when buying or selling mutual funds. Transactional fees are very similar to one-off fees, but instead of costs you directly incur when you buy or sell a fund, these refer to the charges that the actual fund has to pay when they're rebalancing or maintaining it. This includes things like bid-offer spreads they will pay, any taxes they might incur, and anything else that crops up. These fees do apply to both ETFs and mutual funds. However, mutual funds tend to have higher internal transaction costs due to their structure and how they're managed. In the example of our 2 funds, again, Vanguard cannot provide an exact fee that you will pay, but they do offer an estimate, and on the annual statement that we're looking at for the FTSE All World ETF, it's 0.03%. Then for the Global All Cap Index Fund, it's 0.1%. What's interesting though is that these figures differ from what Vanguard have listed on their most recent costs and charges documents, where they've estimated you'll pay 0.02% and 0.08% respectively. So it's important to remember that your fees will differ, and these are just examples for the purpose of the video. The fourth and final fee that you could pay when buying and selling index funds are called incidental fees, and these are often taken as an incentive for the fund to perform well. So the better the fund performs, the more you will pay in incidental fees. Vanguard currently doesn't charge incidental fees on any of their funds, and these are quite rare to find on funds in the UK in general. Most retail-friendly funds, especially those that passively track an index, avoid them completely. So in total, based on the figures we're looking at for each fund, you would have paid 0.35% in fees for the FTSE All World ETF and 0.33% for the Global All Cap Index Fund, even though they only display a charge of 0.22% and 0.23% respectively. But now we've been through everything, let's answer the important question. How would this small difference in fees affect your investments long term? Well, for many of you, it won't. Let me explain. If you invest into an index fund or ETF and receive a 9% yearly return, you are getting a 9% return. These hidden fees don't affect that because they're already included within your return. But the fees can still make a difference to lots of you. Let's say you're looking at an index that you want to invest in and you land on the S&P 500. Lots of people talk about this index having an average yearly return of around 10%, but here's the thing. Any fund you invest in won't have exactly the same return as the index itself. This is partly due to all these additional costs you have when investing into a fund that tracks it, and also partly because no fund will track the index perfectly. But obviously we're focusing on just the fees aspect today. So if you're thinking, I'm going to invest into this fund because the index gets a 10% return each year, well, it's not quite that simple. The returns aren't guaranteed for a start, but also you won't achieve the full return. You'll get a small percentage under it depending on the fees that you pay. As a bit of an experiment, let's calculate the difference between the potential return with the advertised fees versus the real fees, including the hidden fees that we've spoken about today. To do this, we'll run a compound interest calculation using a calculator that allows you to put fees in, like ours on financial interest, linked in the description below. And we'll run this based on paying 0.22% first, and then again while paying 0.35% a year to see the difference. For the purpose of the calculation, we'll assume an ambitious 9% average annual return on investment over a 40-year investing period where we invest £200 per month. If you paid 0.22% a year in fees, you'd have paid close to £18,000 in fees after 40 years. And the impact this would have on your portfolio would be around £52,000. Whereas if you paid 0.35% a year, with everything else kept the exact same, you'd pay just over £27,000 in fees, and the impact it would have on your portfolio would be over £80,000. That's a difference of around £30,000 over your investing journey, and this is just with a small difference in fees. Imagine what it would be if you weren't accounting for fees in the first place. Remember though, these numbers are just an estimate based off of the information we put into the calculator and are not an accurate prediction of what you could earn. All investments have risk and can increase or decrease in value, and past performance is never a reliable indicator of future results. So why am I telling you all of this? Well, it's important to remember that the average returns of the underlying index will not be the same as the returns of the fund that you're investing into. So always keep that in mind when forecasting or researching an investment. Then on top of that, if you're factoring fund fees into your forecasts, just be aware that the displayed figure on the fund isn't all that you'll pay, and this can impact your future returns. And if you're not thinking about fees at all, so trading fees, platform fees, plus all of the fees we've spoken about today, maybe you should give our calculator a try. But just to warn you, it might make you want to find a cheaper broker.